We hear the word investment all the time. I'm investing in my education. This new TV is an investment. But what does that word really mean? Is a new car an investment? No, it's not. It's an expense. Let's get real. Today, we're breaking down the only 3 types of investments that actually exist. In the world of finance, an investment is simple. It's something you buy with the expectation that it will produce income or profit, or both. That's it. It's not a car, a TV, or even your morning coffee, no matter how much it helps you. So, if those aren't investments, what are? There are only 3 main categories: ownership, lending, and cash equivalents. Let's dive in. First up, ownership investments. This is what most people think of when they hear the word investing. It's about owning a part of something that will hopefully grow in value. The most common example is stocks. When you buy a stock, you're buying a small piece of a company. You own it, and you can make money in 2 ways. Capital gains. This is when the stock's price goes up. Say you buy a share of a company for $100 and sell it later for $150. That $50 profit is a capital gain. Dividends. Some companies share their profits with you, the shareholder. This cash payment is called a dividend. It's basically a thank you note from the company, but in money form. But it's not just stocks. Other ownership investments include your own business. If you start a company, you own it. And if it's successful, you can make a huge fortune. Real estate. Buying a house or apartment to rent out or resell is a classic ownership investment. The hope is that its value will increase over time. Precious objects, things like gold, collectibles, or art. These are ownership investments only if you buy them with the intention of selling them for profit later. Remember, a new couch for your living room is an expense. A famous painting you plan to sell is an investment. The second type is lending investments. This one's simple. You are the lender. You lend money to a company, a bank, or even the government, and they pay you back with interest. The risk is usually lower than ownership investments, so the rewards are more modest. The simplest example, a savings account. You put your money in the bank. The bank pays you a little interest. In return, the bank uses your money to lend to other people and businesses at a higher rate. You're essentially lending the bank your cash. A more well-known example is a bond. When you buy a bond, you're lending money to a company or a government. They agree to pay you back with a set amount of interest over a set period. It's a bit like an IOU. The primary risk is that the borrower goes bankrupt and can't pay you back. But for things like U.S. government bonds, the risk is extremely low. Finally, we have cash equivalents. These are investments that are as good as cash. They are highly liquid, meaning you can convert them back into cash very quickly without losing much value. They generally offer a small return. A great example is a money market fund. It's like a savings account, but often with a slightly higher interest rate. The trade-off is that you might agree to leave the money alone for a specific period, like a few months or a year. The main benefit is their liquidity. You can easily access the money when you need it. So there you have it. The next time you hear someone say they're investing in a new gadget or an expensive meal, you'll know the truth. An investment is not something that loses value over time. It's one of these 3 things: ownership, like stocks or real estate; lending, like bonds or savings accounts; or a cash equivalent, like a money market fund. Understanding these basic categories is the first step to building a solid financial future. What's the biggest investment mistake you've ever made, or the best one? Let me know in the comments below. Don't forget to like this video and subscribe for more straightforward financial tips. Thanks for watching. Is the Fed about to cut interest rates? Friday's inflation report just gave us a huge clue. The latest Personal Consumption Expenditures Index, or PCE, is in. It's the Fed's favorite inflation gauge, and it's holding steady at 2.6%. But here's the catch. The core PCE, which strips out food and energy, ticked up slightly to 2.9%. The Fed's target is 2%, so these numbers are still a bit high. Higher inflation usually means the Fed keeps rates higher, but traders are betting on a rate cut anyway. Why? Because the Fed is also watching the job market very closely. A recent speech from Fed Chair Jerome Powell hinted that weakness in the labor market could be the key to unlocking a rate cut. So while inflation is still a concern, the focus is now squarely on the upcoming jobs report. Will it be weak enough to give the Fed what it needs to cut rates? The market thinks so, with an 87% chance priced in. What do you think about the Fed's next move? Let us know in the comments below. And if you found this helpful, smash that like button and subscribe for more insights. The 1970s, gas prices through the roof. The economy stalled. A new word was born: stagflation. It's that rare, painful combo of high inflation and low economic growth. But now it's back, and experts are calling it stagflation light. Why? Tariffs. They're making everything more expensive. At the same time, they're slowing down business and job growth. It's a 1-2 punch that's hitting the economy right now. So prices are rising, and the job market is slowing. But don't panic. It's not the 70s all over again. Back then, inflation was out of control, hitting double digits. This time, forecasters expect it to peak around 3.5%. Uncomfortable, but not a full-blown crisis. The big question is what the Fed will do. To end stagflation, they might have to raise interest rates, which could slow things down even more. This time, there's another factor: the Fed's independence. Will politics influence their decisions? And what does that mean for the economy? Only time will tell. Do you think the economy will get better or worse? Let me know in the comments. And don't forget to like and subscribe for more videos like this. Ever wondered what goes on behind each of our videos? Our passion is to dive deep into the financial market, find the best information, and translate it all for you in a clear and simple way. And right now, we have a mission to build a strong community of 1,000 people who, like us, are passionate about finance and want to grow. If you enjoy our content and want to be part of this journey, your click on the subscribe button is what fuels our growth. It's fast and helps us immensely. Thank you so much for watching and for all your support. We're just getting started. The US government just tried to force Google to sell its most popular product, and the entire stock market held its breath. What happened next will shock you. So did they do it? When the news broke, the tech world went wild. The Nasdaq, basically tech's high school cafeteria, shot up, and Google's parent company, Alphabet, it launched 8% to an all-time high. Someone popped the champagne. Apple even got a 3% boost just for being Google's bestie. But the Dow Jones, the market's grumpy grandpa, decided to wake up on the wrong side of the bed and fell 0.5%. Talk about mixed signals. Meanwhile, the rest of the economy was having a full-blown identity crisis. Job openings fell to a one-year low, making the Federal Reserve sweat over interest rates. Oil prices slipped like they were on a banana peel. And gold went full Super Saiyan, hitting another record high because, well, chaos is its favorite breakfast. So, back to the big question. The entire market is flipping out. What actually happened to Google? Did they get broken up? The answer is no. A judge ruled they don't have to sell their Chrome browser. They just can't make those sneaky exclusive, you can't sit with us deals anymore. Basically, Google was sentenced to community service instead of life in prison. They dodged a bullet the size of a planet. For more market madness made simple, smash that like button and subscribe for more. Is gold the new Bitcoin? Is the future golden? Gold just hit an all-time record high. Move over, Bitcoin, there's a new sheriff in town, and it's 3,000 years old. Gold prices are skyrocketing, up 35% this year alone. It's like gold found a cheat code. Why the sudden glow up? Well, we've got central banks buying it like it's going out of style, some geopolitical drama in the Middle East, and enough economic uncertainty to make your head spin. Basically, when the world feels like it's on fire, gold is the ultimate fire extinguisher that also makes you rich. Now, my fellow treasure hunters, the charts are telling a fascinating story. Gold was stuck in a symmetrical triangle, which sounds like a geometry class nightmare, but in finance, it means something big is about to happen. And guess what? It broke out, like a kid finally escaping detention. Trading volume is through the roof, meaning everyone suddenly wants a piece of this shiny action. It's like the stock market's version of a Black Friday sale, but for gold. So, the burning question, how high can this golden rocket actually go? Are we talking to the moon or just a really fancy Starbucks? Is gold the new must-have in your digital wallet? Will it keep shining brighter than your future? Let me know what you think in the comments. And if you want to stay ahead of the game, make sure to like this video and subscribe for more market insights that are pure gold. Did the U.S. economy just secretly have its first month of job losses since the pandemic began? The official numbers say no, but the truth is hiding in plain sight. Okay, so the new jobs report for August dropped and the U.S. added 22,000 jobs, which sounds fine, like getting socks for your birthday. It's not nothing, but you're not excited about it, especially when economists predicted 75,000 jobs. They ordered a massive pizza party, and only one guy and his cousin showed up. To make it spicier, the unemployment rate ticked up to 4.3%, the highest it's been since 2021. But that's not the real story. Here comes the plot twist. The government went back and looked at the numbers from 2 months ago, from June. Remember that tiny gain of 14,000 jobs they proudly announced? Yeah, about that. After rechecking their math, it's now a loss of 13,000 jobs. That's right, they told us we gained ground, but we were actually sliding backwards. It's the first official month of job losses since December 2020. They just forgot to tell us for a couple of months. Surprise! One economist says the job market is going from frozen to cracking, which sounds painful. Most industries are losing jobs. The only places really adding jobs were in healthcare and hospitality. So I guess the new American dream is to become a nurse who can mix a mean margarita? So is this a tiny crack in the ice, or are we all about to go for a very cold swim? Let me know what you think in the comments.